Sure. So I started off as an investment banker at the start of my career. And then after that, I joined Fidelity around 10 years ago, where I rotated through different sectors as an analyst initially. So rotating through aerospace defense and airlines and other industrials, then rotating through tech. I would say around 4 years ago, I started to transition to a portfolio manager, initially working on our analyst fund. And then really around 3 years ago, I started working with Sam Morse, who I still to this day work with on the Fidelity European Trust. So I'm co-portfolio manager currently on the Fidelity European Trust. Our process really relies on investing in dividend growers, i.e. companies that we feel can consistently grow their dividend year in, year out over the next 5 years. And that's a differentiated approach, really, we feel, because when customers or clients see the word dividend, they immediately think of classical dividend funds, dividend yields 5, 6, 7%. Our fund, the word growth is equally important to the word dividend. So for us, dividend is important, but dividend growth is equally important. And what that means is that actually our fund is typically more expensive than the market on a dividend yield basis. But on a dividend growth basis and on a sustainability of dividend growth, we score much more highly. And that's really what we believe is the secret sauce, is having a dividend, but a growing dividend and a sustainably growing dividend, which has shown through market cycles to be able to outperform. As I mentioned, Sam and I have come through the classical analyst model at Fidelity. We have around 150 analysts around the world, which is really an army of guys and girls crunching information on stocks. And that's a resource that's invaluable to us. So for us, the core of the process would be an analyst coming up with a new buy-rated name or a name that they had already on their watch list, but now perhaps the valuation was cheaper. So typically the process will start with us seeing a note that an analyst has written or the analyst emailing us, and that will really be the catalyst to start doing more work on an idea. From there, we'll run it through kind of our key screens, so things like dividend growth, cash generation, balance sheet strength, so all of these to make sure that it's not just a good idea, but it's a good idea for us. After that, we'll typically meet management once, at least, usually twice, before pulling the trigger if we like what we've seen, and then buying it from there. For us, a typical holding period is around 5 years. So our turnover is around 20%. So really one of the longer holding periods of fund managers out there. And combined with bottom-up stock picking, long holding period and bottom-up stock picking are really two of the core tenets of what we do. Not because that's the only way to manage money, but for us, the way we've been schooled is bottom-up, long-term focused stock pickers. And one of the happy byproducts of that is that our transaction costs are very low. So, one of the guaranteed ways to lose money in our industry is to overtrade, and we take the opposite approach. So, one of the lowest turnovers at Fidelity and also one of the lowest transaction fees at Fidelity. It's been pretty good, to be honest, particularly given everything that's happened. So, our fund has a slight growth tilt, a slight quality tilt. So given, value has had its best year ever, the fact that we've managed to outperform by around 2 to 4% over that time period, 2% over the last year, more like 4% post fees, should I say, over the last 3 to 5 year periods has been pretty pleasing to us. And I think it speaks to two things. Firstly, that we do have a balanced ship. So we do have some tilts towards quality and growth, as I mentioned, but we still keep it relatively balanced. And secondly, even in years like 2022 or 2023, very kind of top-down driven, we can make sure that it's bottom-up stock picking that's still driving the majority of our returns. Yeah, so for us, priority number 1, 2, and 3 for customers is preservation of capital, particularly relative to the benchmark. So the worst thing we want to ever have happen is the market is down 10%. we down 20%, and we have to go back to customers and say, we're sorry, we called something factor A, B, and C wrong, and therefore, we've underperformed in even worse than a bad market. So for us, making sure that we outperform in down markets and preserve as much capital in down markets is priority number 1, 2, and 3. And we do that through a few ways. Firstly, on an unlevered basis, we run with a beta of less than 1. We spend a lot of time thinking of kind of sector allocation and making sure that we're within plus or minus 5% range of the benchmark for each subsector. So no big sector bets, no big factor bets, no big top-down bets. And then lastly, on the kind of stock-specific part, we spend a lot more time thinking about what can go wrong than what can go right. So for example, trough valuation, how much can earnings fall, etc., rather than, can we outperform by 2, 3, 4 times, the markets with a stock over a 6-month period, say. So to answer the question more directly, the kind of market where we will do best in is, a sharply kind of falling market like we had in 2022, like we had around the GFC or the likes. Kind of market where we will keep up with the pace generally is if it's a slow uptrend, such as what we saw, most of the last cycle, we can generally keep up. But where we will definitely struggle is a sharp, kind of sudden upwards rally, such as we saw after the vaccine rally, where you had a very sharp, sudden, value-driven rally. That's where we'll struggle in.